You know, for decades, the stock market had this secret hidden right there in the calendar. It was this powerful, almost magical pattern that basically said the first month of the year held the key to some really incredible returns. So today, we're going to dive into the fascinating story of its rise and, well, its mysterious fall. This is the January anomaly. Yeah, you've probably heard this old Wall Street saying before. It was made famous by Yale Hirsch, and it's this classic piece of market folklore. And the whole idea behind it is pretty profound, right? It suggests that January's performance isn't just another 31 days on the calendar, it's some kind of powerful predictor for the entire year to come.
But okay, is there actually any truth to it? Was this a real market secret that smart investors could actually use to their advantage? Or is it just a dangerous myth that kind of leads people down the wrong path? Well, that's what we're here to find out. We're going to follow the evidence and really uncover the truth behind this legend. All right, so to really understand where we are today, we have to go back to the very beginning. We need to see how this simple observation grew into a full-blown Wall Street legend. And believe me, for a very long time, the data was incredibly convincing.
So the story really kicks off with an investment banker named Sidney Wachtel. Back in 1942, he published some observations he'd been making on market data all the way back to 1925. And what he noticed was that smaller companies, what we now call small cap stocks, they just seemed to crush it in January consistently. But it wasn't until this landmark study in 1976 by Rosef and Kinney that the January effect was really cemented as a legitimate, robust thing in the markets. And right at the heart of their big discovery was this absolutely stunning number. What Rosef and Kinney found was that between 1904 and 1974, the average return for stocks just in the month of January was 3.48%. Now, to really put that in perspective, you have to compare it to the rest of the year. You're looking at an average of nearly 3.5% in January versus less than 0.5% for the other 11 months. This was not some small statistical quirk, okay? This was a powerful, recurring pattern. So naturally, the big question became, why? What was causing this?
So, what exactly was the secret engine driving this, year in and year out? Well, economists came up with a few key theories, but one of them really stood out as the most likely culprit.
Okay, the most popular explanation is something called the tax loss selling hypothesis. And the easiest way to think about it is like a year-end clearance sale for stocks. Here's how it worked. In December, investors would sell off their losing stocks to claim a capital loss. Why? Because they could use that loss to lower their tax bill. Simple enough. But all that selling pressure would artificially push those stock prices down. And then, what happens in January? Those same investors come back, often with fresh cash, and buy up those now discounted stocks, which causes this predictable surge. And that wasn't the only thing fueling the fire, not by a long shot. You also had the big institutional fund managers doing what's called window dressing. Basically, they'd sell off their losing stocks right before sending out those year-end reports to their clients, to make everything look a little prettier. On top of that, you have this really powerful psychological effect of a fresh start in the new year. People get their year-end bonuses, they're making new contributions to retirement accounts, and all that new money floods into the market ready to be invested.
Now, this brings us to the anomaly's famous cousin, the January barometer. This is a little different. It's not about small stocks outperforming. The barometer is the idea that the direction of the S&P 500 in January can actually predict the direction for the entire rest of the year. So the question is, how accurate is it, really?
Well, at first glance, the historical data is pretty compelling. Get this. When the S&P 500 has a positive January, the rest of the year ends up being positive a staggering 82% of the time. I mean, that looks like a pretty reliable forecasting tool, right?
Well, here's the catch. When January is negative, the year only ends up being negative 54% of the time. I mean, think about that. That's barely better than a coin flip. So the barometer's predictive power, it's almost entirely one-sided. And that, my friends, is a major, major flaw.
But you know what? The biggest flaw wasn't even in the barometer. It was in the original January effect itself. Because in the modern era, all that magic that powered this anomaly for almost a century, it's just started to vanish. Yeah, this data right here tells the entire story of the decline. Just look at that top row. Back in the mid-20th century, January was a winning month for small-cap stocks 78% of the time, with a really powerful 3.8% premium. But then, as you move down through the decades, you can just see the decay.
the success rate drops, the premium shrinks, and it just keeps going down until you get to today, where it's basically a shadow of its former self. I mean, look at just how dramatic that decay really is. The January premium, that's the extra return you could once pretty reliably expect. It has shrunk all the way from a high of 3.8% down to just 1.2% today. That's a collapse of over 60%. The effect is now really just a ghost of what it used to be.
So the obvious question is, what happened? What killed what was once one of the most reliable patterns in financial history? Well, it turns out there were three main culprits. All right, culprit number one, technology. These days, lightning-fast trading algorithms can spot a predictable pattern like this and profit from it in milliseconds, literally erasing the opportunity before a human investor can even blink. Second, the rise of tax-sheltered retirement accounts, like 401ks. This basically removed the main reason for all that December tax law selling in the first place. And finally, and maybe most importantly, the secret just got out. Once everybody knows about an anomaly, everyone tries to get ahead of it. And when that happens, you end up neutralizing the effect completely.
So, what's the final verdict on the January anomaly? Well, its story, its rise and fall, actually offers a really crucial lesson about the very nature of financial markets themselves. It really all comes down to one core concept: market efficiency. The theory is actually pretty simple. It's the idea that markets are constantly learning. Any predictable patterns, any so-called free lunches, they eventually get discovered and traded on until they just don't exist anymore. And the ghost of the January effect, it's the perfect example of this powerful force in action.
So the big takeaway here is not some hot stock tip for next January. It's a much, much deeper lesson about how markets actually work. They aren't static things. They're dynamic, they're adaptive. They are constantly learning from the past and evolving to wipe out these old patterns.
And that really leaves us with a fascinating question to chew on, doesn't it? The January effect was considered a market truth for nearly 100 years before technology and information just erased it. So it makes you wonder, what widely held market truth of today will be the next one to fade into history?